I welcome you all to our second session. I hope everybody enjoyed the first session, and we are now managing to register for MT4, MT5 accounts on various platforms and brokers. We'll look at those reviews once we are done with the vocabulary. So today we want to look at the vocabulary or glossary that I try to compile. That is something that we are going to be needing very much. So without wasting much of our time, let's quickly jump in. It's going to be interesting. It's going to be fascinating. Let's learn. So the motto for today is plan your goals and stick to your plan. Don't detour anyway. Plan your goals, stick to your plans. That's how you're going to be successful. Right, learn trading with us at www.capitalmarket.isisekelogroup.co.za. All right, so let us look at the first word that I compiled here as my number one is balance. This is the amount in your account. Remember, we opened our accounts. You deposit your money in your account. That money, before you trade, balance, that is your money in your account. We are going to look at or come across this word or two words, base currency. What is a base currency? So when you look at Forex, as I explained in the first session, we always get two pairs. We always get currencies paired together. In this instance, I paired the euro dollar. Okay, so the first currency is euro. So the first currency mentioned in this pair being euro, the euro is the base currency. So what is the US dollar? The US dollar becomes the secondary currency. Some call it the court currency. So what we are saying is, when you see a pair, euro dollar, with a price of 1.6122, we are saying we actually need $1.61 to buy 1 euro. Don't worry about the 122. Okay, we'll learn about this practically in our workshop. What is a bear market? A bear market is a market where we see the value of securities decreasing. If it's gold, it's losing its value. If it's oil, it's losing its value. If it's dollar, it's losing its value. A market of decreasing security value. And this is caused by investors being pessimistic about the environment. So I'm an investor, for instance. I want to sell my gold because I don't believe that gold is going to gain any values anytime soon, for instance. So the prices of that gold is going to decrease even further because people like me multiply them by 5 million. We are all selling that commodity. So that value decreases. It's always about supply and demand. Where there's no demand, the value decreases. It becomes a bear market. So these conditions are usually defined by a 20% move lower from the highs, from the prices that were here, which are going down. We'll learn about that in detail in our practical lessons. So what do we mean when we say bearish? That's another investor behavior. That's another market behavior. For instance, right now, during the pandemic, we don't have any investor behavior. We have a market behavior. There is no business in the market. So everything is bearish. So bearish may be described like bearish as long as values begin to fall in the market. Look at stocks, look at oil currently. That's a bearish market. What's break-even point? We are always going to hear me talking about break-even. When I am selling, let's say, gold or euro dollar and I was expecting a profit. It's not coming my way. It's been the whole day. I was in $5 minus. Now it's on 0.0. It's much better. I've lost nothing. Then I close my trade. The point at which my investment, which I expected to get profits in return, is not yielding anything. And at the moment, it's 0.0. That's break-even point. So I can say, guys, let's close this trade at break-even. That's what I mean. Don't close it on minus. Don't close it at a minus. Close it on 0.0 because it ain't going away. All right. The opposite, bullish. We always talk about bears and bulls. So bullish, another investor behavior, another market behavior, which is described as bullish. This is when values are rising, skyrocketing, okay, over a defined period of time. Look at gold currently. It's really going, it's pushing up. Okay, that's a bullish behavior. Okay, here's a bull representing a bull market. That's a market of increasing value in securities. Okay, it can be gold, it can be dollar, it can be whatever. The value of whatever you're looking at that time is really going up. Okay, this is reinforced by investors being optimistic and very confident. So as investors all desire to buy securities, the prices of those securities, what happen? They increase even more because it's supply and demand. If all investors want to buy the same thing, obviously the banks are going to put up a better, higher price so that they can cope with the demand. Okay, we'll learn these things in detail. What's a buy signal? A buy signal is an indication for investors to put in their money because there is profit to be made. Okay, there are obviously some conditions that are going to usher in the sentiment of wanting to buy something. Okay, we'll learn more about it. Let's look at what is a buy limit. We will talk about 4 types of pending orders, which is buy limit, sell stop, buy stop. So the first one being buy limit, that's a buy, but it's not a buy at the current price. Not really. It's a future buy price. Okay, yeah, you want to buy something at a certain price, but the price is right here for now. Okay, the price is right here for now. You want to buy, but the price is already high, so you put a price lower. Okay, so that when this price decreases and hits this price below here, it becomes a buy. It becomes an active live buy. So that's what but anyway, we'll learn about it in detail. The other one is a buy stop, okay, which is a pending or future buy again, but the value right now is not placed below, it's placed above. So the market price is here, but we set our buy stop right here. If the market pushes up and triggers this level, then we are in a buy. We call a buy a long position. Okay, we'll learn about that. What's an economic indicator? There you can see an economic calendar. That's a calendar which is receiving and broadcasting economic data, and this data indicates the health of an economy, and it indicates the financial market. Okay, so the most let me paraphrase this. Economic indicator is not a data which is coming from the economic data. So economic data, it's what we look at, looking for information about the status of an economy of a particular country the status of its financial market, that particular country. When we have that data, then it's put on a calendar for us to see what to do as investors, as traders. Are we going to buy? Are we going to sell? So the most pertinent is the data that is released on a regular basis by government agencies regarding it could be their inflation, could be their GDP. By the way, GDP, we'll learn about it. It could be about employment, about prices of major commodities in their country, investor confidence, a lot of things. We'll learn about it. And this is the information that we need for us to make money in Forex. Okay, we'll learn about it. What about ECN, Electronic Communications Network? This is a network that connects the investors like you and me, the traders, whether it's commercial or retail. We are connected to the real market where the major institutions are operating. Remember, in our first session, we said we have banks here, we have brokers here, then we have ourselves here. And there's no way we can bypass the brokers because they are the institutions that are licensed to connect with the banks and then to give us service as investors or as traders. So what happens now, if a broker uses the ECN network, the EC network, what happens is that, yes, we are their clients, but we are not going to trade with the broker. They are going to give us access to the actual market. That's why I said, here's my definition: bypassing personal brokers and enabling individuals to trade directly with major institutions. Anyway, we'll see this as we do hands-on workshops. Equity. We talked about balance. The synonym of balance can be equity, if we may say, because this is the amount of funds that in trading it's what we call the margin, or the total amount that you have to deposit or that you have deposited. And from that money you've deposited, you expect to trade and make profit, make losses. So that money, we call it equity. Okay, we'll understand it much better. Let's look at ECB. We hear a lot about ECB. ECB, what is this ECB? ECB, it's European Central Bank, which is in Frankfurt. 1998, they established this in preparation to combine all European countries to form the Eurozone. Okay, so it's not a bank run by one country. It has actually shareholders of national central banks. You talk about German, you talk about Italy, you talk about all other countries in Portugal, Spain, all these countries. They are shareholders, they are national banks to the ECB. And actually other financial big institutions, they can also participate being shareholders. So we have to understand the responsibilities of the ECB. Okay, their task number one is implementing monetary policy. Okay, so all the policies about Europe is ECB's duty, and also maintaining stability of inflation. They have to maintain throughout Europe the 2% inflation rate. But anyway, for now it can be confusing for somebody who's starting. But those people who are doing management, economics, you might have an idea of that information. I don't know, but you understand it better. And this is what we do when we are doing fundamentals. We need such data as it is released in real time. All right, let us look at what is a gap. I put an illustration because it's difficult to explain, but in simple terms, a gap is simply a change in price levels that usually happen when a market session is closing and then a new session is opening. When they collide, these guys, they close their prices at a certain price, and these ones, they want to open at a certain price, and then we see nothing between, and that is what you see here. The price was here, and now the price is there. What happened here? We don't have any illustration here. It happened again here. Now the price is here. Normally, this can be a result of either fundamental adjustment or technical adjustment, and later the prices will be filled, okay, like prices return to previous levels or they don't. It depends. So as as traders, we love to speculate what is going to happen, and we put on our pending orders or whatever. So gaps are defined as either full, partial, or up or down. They can also be classified as breakaway, exhaustion, common, continuous, whatever the case may be. We'll learn more about it practically. Okay, let's move on. I actually introduced in passing that we'll look at what is GDP. For those who are in management economics, I think it's familiar. That's gross domestic product, and there's a lot of confusion here. I would like to suggest that maybe just Google it up, try to see the differences, okay? Because GDP is actually just the total fiscal value of all goods that are manufactured in a particular country or services, okay, provided in a country over a period of time. And we love to follow GDP reports because there's money to be made in Forex if you know these things. So changes in GDP, they're typically measured quarterly by a country, or they can do it annually, but occasionally they do also monthly, okay? So it should not be confused whatsoever with GDP per capita. Look it up, please. And if you look at what is GDP per capita, it's not what I'm saying. GDP capita is simply the total output per person, okay? Not total fiscal value for goods manufactured or services. It's different. And also, this gross domestic product, GDP, it's grossly confused by people with GNP. GNP is gross national product, which measures the total of production and services, production of services by the country, regardless of location. So we're not talking about that. We are simply talking about GDP, which equals the value of all goods and all services that are adjusted for inflation. Okay, not talking about GDP nominal. That is not done for inflation. Let's look it up. Let's learn more. I know it's a bit of too much economics, but it will help us to make lots of money in Forex. Okay, let's move on. GNP, like I was saying, this is just gross national product. This one equals GDP plus income of foreign investments. Okay, not in the country, foreign investments and labor with domestic earnings by foreigners subtracted. Okay, done with that. Let's look at what is hedge in Forex. In general terms, hedge is that hedge we know from home, a fence, a shrub, trees, that you protect your yard as a fence or something. Okay, so in Forex, it's the same idea. Hedge is to you fence yourself against any loss or any potential loss you don't want. So if I want to invest in something, let's say I put money in USD, I'm selling, then I'm on $400 loss, and then I know that US dollar and GBP US, they somehow correspond the movement. So I will know as US dollar is doing the same, GBP US dollar is doing the same. So I'll put a lot of money in GBP USD trying to cover the loss on US dollar. I'm trying to cancel off my loss and make profit out of it. So the other people who use as a strategy of hedging in Forex, it's up to you. Later with your experience, you will choose who you are in Forex. So hedging may be undertaken through a variety of financial instruments. You can do it in stocks, ETFs, Forex, forward swaps, options. Now let's look at lot size. Lot size, we have to do a thorough workshop because this is being treated differently per broker. You look at plus 500, you look at IQ options. These two brokers, they don't use lot size, they use the money value. You have to put your volume of your trade as mandatory. Now, MT4 brokers, they use lot sizes. So what is lot size? It's simply the measurement used to determine the volume of your trade. That's why I said here, you can see here, you can't put money here. You have to know what lot size, what's volume. So lot size is just the volume of your investment on, let's say this was US oil, whether you're selling or buying, but you need your lot size there. So I'll teach you how to calculate your lot sizes and know on $100 what is a portion that I can take as lot size. Don't worry about it, we'll learn about it. Now, margin required, this can refer to various issues outside of forex trading. We can have all those reasons: amount of money borrowed to buy security, or the difference between price and product cost, or the difference between the given interest and the base interest on an adjustable rate of mortgage, or as it is in forex trading, which is a portion, just a portion of your total invested equity. So you have $100, you take $10. Okay, that's the margin required, okay, for you to trade. You don't take all of it, just a portion. But we can slot this into sections. We have what we call initial margin requirement. That's what I'm talking about. But if you check in Forex, it's chopped into sections because margin may refer to used margin, it can refer to usable margin, it can refer to required margin. So you need to know the differences here. So used margin is the amount of equity that you provide as a trader to cover a loss that you are running in trades. Okay, that's used margin. While usable margin is the remainder, okay, of your equity. Okay, whatever it is, you can actually withdraw it. It's usable. Then we have what we call required margin. That's the amount of balance required for anyone to open a new position. Okay, don't worry about this. We'll learn more about this practically. Now, I love brokers like Plus 500. It's a broker from Australia. It's a market maker. It's not an ECN broker. Now, they send you a message as a text or as in email, written margin call. They send it when you have taken a portion. Let's say you have $500. You take $50. You put it in the market, and then you say, I do not want to lose $500. I put $50. I don't want to lose $50. As the day is going and the trade goes against you, and that $50 is now depleted, it's 50 cents now or something close to zero. They will send you a message to say, margin call, put more money to support this trade, not from your balance. Any extra money that you have to deposit. Even if you have 450 in the account, they will not accept it. You need to deposit something extra to support your trade. I love it, that system that they have. I really like it, because in the event that usable margin falls below the required margin, they have a system that will begin to close your positions automatically. Whether they don't have a stop loss, they will close it automatically, and this protects you from falling into negative balance or blowing your account. Now, MT4 accounts, platforms, I meant to say, they don't have this system. You have to exercise proper risk management and use the stop loss orders. If you don't put your stop loss to say, okay, I have $1,000, I'm putting $100 in the market, I don't want to lose $100. If you don't put it, that $100 can go to zero, and then minus 10, minus 200, minus 300, and do it minus $1,000. You come back home, your $1,000 is gone. So margin call really protects us, but unfortunately, not many brokers have margin call configurations. What we'll learn about it in further detail. Market execution. What is market execution? If I look at Eurocard here, and if I want to sell, this is the price 1.52. If I want to buy, it's 1.52.671, yes, 618. So either I want to sell or I want to buy. These are the prices that are available, and I do that and do a market execution. Okay, so market execution is a transaction execution in which the orders are filled at these best prices available. Okay, that's it. We'll learn about it more and understand it more practically. Let's look at the market maker. Like I was saying, plus 500, they're not ECN, they're market maker. This is a broker or a bank or financial institution that they quote from the buy and sell. In fact, whatever they offer you on their platform, they put a markup, and we call that markup spread. Okay, so market makers, they try to attract us. They try to attract us by offering a lot of services. Some they say your deposit to give you like 100% bonus. Some will say we have the lowest spreads and all that. But what they do is they put a spread. Have you ever seen, like on brokers like Vex or brokers like XM, the moment you put a buy or a sell, you're in a big loss. And then after some 2-3 minutes, your trade goes back to 0-0, and then you start to see normal profits or small losses. That first big loss, it's a markup, it's a spread. You are actually paying it to the broker. Enough of that. We'll learn it in detail. Let's talk about pending orders. Pending order is an order that opens only if the asset achieves a predetermined price value, and we have buy limit, sell limit, buy stop, sell stop. We'll learn about this practically. I don't have to discuss it a lot here because we'll have to do it practically on the charts. A position is an open trade or transaction in securities. Okay, if I open a position, I have initiated a position. If I close it, the trade is concluded. Okay, so a position can be long, which is buy, or it can be short, which is sell. Okay, we'll look at this again in a more detailed manner in practicals. The rates, I think everybody knows about rates. That's the price of one currency against another. What is the rate of dollar rand today? I think it's 19. Resistance and also support. Forex got two sides. They got top side, lower side, highs, lows, ceiling, from support, resistance, from they play ping pong. So resistance, traders actually draw using historical data that, okay, this is the level from December, the prices come here, they go back down, they come here, they go back down, they come here, they go back down. Now we are here again, they have to go down. They have to. There's no guarantee, but they are using historical data, thereby they draw a line and they call this resistance line. They do the same on the bottom, support line, and they tell you, I'm going to teach you support and resistance. Boom. And you pay big money to learn about support and resistance, but it's just historical data. You don't need to learn that. You can do it alone. Okay. Anyway, that's support and resistance. So resistance lines on a price chart, they just indicate the level that the price of an instrument, if it's gold, if it's euro dollar, if it's US CAD, it's going to always have difficulty rising above this level. So it becomes resistance. The opposite is true. The support lines, they indicate future price levels, especially in the case of prices crossing them. They fail to cross here. That's it. We'll learn about it in detail. Guys, I don't want to mention anything about risk. Risk is number one thing that we do as traders. So we have to learn about risk management. That is being able to identify, to assess, and prioritize risks in order to maximize on profits and minimize on losses. That's it. We minimize losses, we maximize profits. That's risk management. We learn about it hands-on. We'll have to be calculating. We have to master on risk management. So there's a lot of hands-on coming that you need to be prepared of. All right. RSI is just a technical indicator. I use it a lot. It measures the velocity and magnitude of an instrument. Okay, you see it hands-on, but it means a relative strength index. You can actually install it on your MT4. It's there. I'll be showing you. All right. We spoke about sell limit. So sell limit, let me just explain real quick. Remember, it's a sell, but it's not a sell at market level right now. It's a future sell. But you want to sell, but the price is here already, and you want to sell. You feel like, let me sell it when it's here. So you put prices here on your chart, such that if prices come up, and trigger that price you set automatically, even if you're not at home, you are now in a sell. All right, we'll talk about it later in detail. What about sell stop? Sell stop is the opposite. Sell stop, the price is already here. Okay, you don't need prices to go up. They are already here. You want them to go down. As they are going down, if they trigger this, then you're in an active sell order. So a pending sell order, it has this specified value market price. So if the price reaches the defined value, a short position is placed. A sell position is automatically initiated. All right. A short position is a sell position. It's a synonym of sell, short, sell, short. Slippage, you don't want me to talk about slippage. It's one thing that brokers make me cry. Slippage is simply the difference between the price of a trade and what was expected. Okay, I was here and I thought the price is gonna go down, and then there are some things that happen there, and then they tell you that it's slippage. Is not as in forex. Slippage refers to when limit or stop loss orders are executed at a worse rate, usually as a result of unexpected news market volatility. Let me give you an example. Let's say I want to buy when the price is here, but for now it's here, so I put my pending order here. Now the prices are coming up, but then they come up very vigorously. Okay, volatility, high impact. So what happens is my price here, because of that pricing of slippages, I'm not there. I've already set my things. They are going to push it to here. And then when the market comes, I was here, it's passing, but there's no price. Now I'm set here, but I'm not here, and it's not me. And then it triggers here. Now my stop loss, when I was here, my stop loss was just here, but now I'm here, my stop loss is not moved. So if this trade fails and comes back, it's gonna blow my account. For now, you may not understand what I'm saying, but we'll look at it practically. But don't forget slippage. It will be good for you to play around babypips.com as well to learn about basic things before my hands touch you to fix you on proper practicals. Spot price is market price. Spread, I've really spoken about spread. Spread is just a markup brokers they put to make profit. Okay, the moment you place an order, you find yourself in a minor loss. That is a spread. Stop loss order, you are in a sell, please put a stop loss. Okay, so that when the price changes to be a buy, they won't pass this price. Okay. Support, I think we spoke about, is the flow. Okay. SAU, that's our the metal prefix is X, it's Latin, so XAU, it symbolizes gold, while XAG symbolizes silver. Argenta. Ladies and gentlemen, it's been an honor being with you. I would encourage you, once you get this skill, to eat, sleep, trade, and repeat the process. You won't regret it. But the number one key thing is, please don't deny yourself. Invest in educating yourself. A skill that is going to bring you your next 1 million